I'm joined now by Farris. He's Global Head of FX Strategy at Credit Suisse. Thanks very much indeed for coming in, Ray.
Thanks for having me.
So I'll start by asking about the euro. Fell yesterday to the lowest level in, more than 10 weeks against the dollar. Debt crisis concerns ongoing in Europe. Where do you stand on the euro? What are the prospects as we reach the end of this year and going into next year?
Sure. Well, the immediate outlook is very much for continued euro weakness. The euro needs some degree of resolution to the stress in credit markets in Europe before it can rally. It is the best hedging vehicle right now because the credit markets themselves have become quite illiquid. So the currency remains liquid. You're getting a lot of markets that are using the euro as their way of hedging illiquid credit risk. And it's just very difficult to see what the trigger for resolution of a lot of this stress between now and the end of the year is. We probably need to get Portugal into an EFSF program. There's still lots of concerns about Spain. So it's just difficult to see that happening in the next 2 or 3 weeks.
And unless that happens, the euro is likely to continue to fall. Where might it be versus the dollar in, say, 6 months from now?
Well, 6 months from now, we tend to think that the euro-dollar will actually be quite a bit higher. Will probably be, we think, sort of up around 140, probably back above 135. And where you get that from is the euro area faces a major test, if you will, in April. I mean, you've got very large debt maturities in Portugal and in Spain. And you're either going to roll those or you're not. And so we tend to think that you're going to have crisis resolution by April. And once you get some degree of reduction in the stress, the dollar is a very vulnerable currency. It has no yield. The euro will have more yield. And you'll get people closing shorts, going back into the currency like we saw in July this year.
So what does all this mean for the dollar?
Well, the dollar fundamentally is it should be a weak currency. It's still in a bear market. We don't expect the dollar to be out of this bear market until well after the Fed hikes rates, so at least for another year and a half or so. But for the dollar to be weak, it has to have a credible alternative. And right now, the euro is sort of disqualifying itself. We think the euro will regain some credibility mid-year, maybe a little bit later next year, and then we'll resume a path of dollar weakness.
The US dollar index, which, as you well know, compares the dollar's performance against 6 of its major trading partners, showed that actually last month it was the best investment. So it beat stocks, bonds, commodities. Is that somewhat surprising, given everyone was saying more stimulus in the US is going to mean a weaker dollar?
Well, I think the best way to think about this is, where are you in this cycle? Okay, and a nice comparison is with the 85 to 95 bear market. And you're at a stage of the cycle where the dollar is still in a bear market. It's still weakening on trend, but it chops around a lot. And the reason it chops around so much and doesn't move a lot from here, it's already weakened a good bit, but there's no real differentiation in policy. It's not as if you've had big interest rate hikes in Europe and nothing in the US. In the core of the G3, Japan, Europe, throw in the UK, there's been really no movement in monetary policy.
So you don't think a weaker euro will automatically mean a stronger dollar?
A weaker euro always automatically means a stronger dollar, okay? But you're moving around in a range. Right now, you're just chopping around. You really need to get some of this credit stress in Europe out of the way, or at least alleviated to some extent, after which you'll then get this fundamental weakness in the dollar showing itself again.
All right, thanks very much for putting that into some perspective.